You've probably seen it happen. A highly anticipated crypto project launches, the community absolutely loses its mind, and then, seemingly out of nowhere, the price just falls off a cliff. So what exactly goes wrong? Is it bad tech, bad luck, or is it just the brutal, unpredictable nature of the market?
Well, in today's Explainer, we're doing a deep dive. We're tearing down the data behind the Saga token to figure out exactly how market forces, technical vulnerabilities, and traders' psychology all collide.
Here is our roadmap for today. First, we'll decode Saga's technological promise, then we'll dissect the anatomy of its sudden price drop, weigh the current bullish and bearish signals, and finally, we'll arm you with some rock-solid crypto risk management strategies. Let's get right to it.
Part 1. The Promise of Saga.
Okay, picture this. Out of a massive 1 billion token supply, only 90 million tokens were actually placed into initial circulation at launch. That's literally just 9% of the total supply. Now, this low initial float is a classic crypto dynamic. It creates this intense scarcity right out of the gate, which can rocket prices upward when demand is hot. But, as we'll see in a minute, it also sets the stage for some incredibly heavy selling pressure down the line when those early investors decide it's time to cash out.
And here's the core technological hook that got everyone so excited. Saga isn't just another generic blockchain. It allows developers to spin up what they call chainlets. Think of a chainlet kind of like a dedicated express lane on a super busy highway built strictly for your specific application. That means zero traffic and zero congestion from other projects. It promises low, predictable fees and essentially infinite horizontal scalability. So if your app suddenly blows up and gets 1 million users overnight, your chainlet can handle the load without crashing the rest of the network. Pretty cool, right?
And look at who they're targeting. A whopping 80% of the 350 projects in their Innovator program are focused entirely on gaming infrastructure. Gaming requires massive transaction throughput and absolutely minimal lag. Saga specifically tailored its flexible stack to attract these developers, creating a very strong, highly specific narrative for their tech. Which brings us to part 2, anatomy of a price drop. Because if the tech is so great, why did the chart look so bad? Well, it was a combination of things. Several compounding factors drove the price down, but it really kicked off with massive selling pressure from users cashing in their free airdrop tokens. You know how it goes. When you distribute free tokens to build hype, a massive chunk of those users will immediately hit the sell button to lock in that free money. Combine that airdrop dumping with early investors taking profits, natural volatility, and wild speculation, and you've got a perfect storm. At that point, it almost doesn't matter how good the chainlet tech is. But, unfortunately, it wasn't just standard market dynamics at play. We have to talk about the major technical catalyst that really shattered confidence, a $7 million exploit back in January. This forced developers to completely pause the Saga EVM chainlet. This wasn't a tiny glitch, this caused an unbelievable 55% drop in total value locked almost overnight. When a network literally has to halt operations to patch a vulnerability, the resulting panic and investor doubt is just catastrophic to momentum.
The fallout was messy. Attackers ended up laundering over $6.2 million through privacy mixers like Tornado Cash, which even triggered a stablecoin depeg within the ecosystem. It served as a really harsh reminder of the inherent smart contract risks that exist, even in the most promising Layer 1 protocols. It's a textbook example of how fast operational risk can wipe out technological promise. Because patching the code, that's the easy part. Rebuilding investor trust takes way, way longer.
Let's move to part 3, bullish versus bearish signals. Where do we go from here?
Right now, the market is completely divided, and both sides have valid points. The bulls point to massive ecosystem rotation momentum within the Cosmos network, meaning they think money is naturally flowing back into these interconnected chains. Plus, they're looking at technical falling wedge patterns, which is a classic sign that sellers are finally getting exhausted, along with the upcoming Saga EVM reopening. But, on the flip side, the bears are warning about the lingering security stigma from that $7 million exploit. They see a descending triangle on the charts, indicating persistent selling pressure. Oh, and they are highly cautious of broader macroeconomic factors, like US CPI inflation data, which can literally drain liquidity from risky assets in a heartbeat.
So for the active traders out there, it's absolutely crucial to watch these specific support and resistance levels. We're waiting to see which way the momentum ultimately breaks. If the price fails to hold that near support of 0.025, it could easily slide down to its major yearly lows around 0.018. However, if the buyers step up and smash through immediate resistance at 0.032, it could completely validate the bullish thesis and spark a much wider recovery toward 43 cents. It is a true, literal make-or-break zone.
And for a little context on the bullish side, check this out. There was recently a massive 123 times spike in average buying volume on Binance. 123 times. That indicates coordinated, speculative flows into the ecosystem. That is not just retail traders buying a few tokens on a Tuesday. A volume spike of that magnitude suggests whales and larger funds are rotating serious capital. But always remember, volume spikes can vanish just as fast as they appear if the underlying fundamentals don't hold up.
All right, let's bring it all together in Part 4, Crypto Risk Management Strategies.
Because honestly, whether a chart forms a beautiful bullish falling wedge or completely succumbs to an unexpected exploit, you absolutely must have a survival toolkit. Think about it. In traditional finance, if your bank fails, you usually have some kind of insurance. In crypto, if a smart contract drains or a coin drops 80% overnight, you are entirely on your own.
Your very first line of defense is disciplined portfolio diversification. You should be keeping roughly half your assets in stable, large-cap coins just to absorb the inevitable shocks of those crazy, volatile, low-cap altcoins. According to risk frameworks from platforms like Changelly, placing 20% of your portfolio in stablecoins and 50% in established giants like Bitcoin or Ethereum is the way to go. Why? Because it means that even if a small-cap project completely goes to zero, the bulk of your actual wealth is protected.
You also need to follow these highly practical steps. Actively block out the emotional noise. Never over-allocate your capital. And please exit your trades in stages. Setting tiered stop losses is a genuinely brilliant strategy. Instead of a hard exit at one single price level, you distribute your exits over a few different price zones. This totally prevents you from being shaken out of a perfectly good trade just because of a temporary volatile price wick. And to truly take emotion out of the driver's seat, you must calculate your exact position size before you enter a trade by multiplying your account size by your risk percentage and then dividing that by your stop distance. You mathematically guarantee that your absolute worst-case scenario is nothing more than a minor paper cut. If you're only risking 1 or 2% of your total account per trade, you can afford to be wrong dozens of times without going broke. And this right here is exactly why you must respect leverage. Look at this. Using 5 times leverage means a mere 20% market drop will instantly liquidate your entire position. 10x leverage? You are completely wiped out by just a 10% dip. In a market where 10% swings routinely happen before breakfast, using high leverage without incredibly strict position sizing is basically just rolling the dice at a casino.
Ultimately, unchecked emotional trading is the single most underestimated threat to your portfolio. It is far more dangerous than any smart contract vulnerability. When you buy just because a token is pumping, that's FOMO. Or you panic sell because of a random rumor on Twitter, that's FUD. You are no longer analyzing, you're just reacting. And trust me, the crypto market is specifically designed to punish emotional reactions.
So I'll leave you with this final thought to ponder as you review your own portfolio and hopefully refine your personal risk management plan. Ask yourself, are your decisions actually grounded in data, technical levels, and strict mathematical risk? Or are you simply gambling on the hype of the latest ecosystem rotation? Master the structure, define your risk, and suddenly, that terrifying volatility becomes a massive opportunity. Thanks for joining me on this explainer, and keep learning out there.